Maybe you've heard the terms IPO or SPAC, which are two popular methods for a private company to list its shares on a public stock exchange. Well, today, we're going to go quickly over a third method, which is referred to as a direct listing. So what is it and how does it work? The direct listing process, also referred to as a direct placement offering, is a method for private companies to sell shares to the public without the help of underwriters, which, as we talked about in our IPO video, is usually an investment bank. But you might be wondering, what are the fundamental differences between an IPO and a direct listing? Well, there are three main advantages. First, the company says adios to having to pay millions of dollars in fees to the underwriters. Of course, this all comes with a trade-off, such as the company has to do more of the work on the regulatory process, like the S-1 registration form. The companies don't go on a typical roadshow like in an IPO, and they don't get special clauses in their contracts, like the green shoe option, that enable underwriters to create more shares on IPO day if there is a large amount of demand, therefore raising more capital. Second, a traditional direct listing does not create new shares in the company, but rather it takes the existing float and places it directly into the market. The positive takeaway here is that the company prevents diluting the shares of early investors, management, and employees who might own shares already. Lastly, going public through a direct listing does not require a lockup period. Well, what is a lockup period? In the IPO process, there is a period of time, usually 180 days from the listing day of the stock, in which early investors are prevented from selling their shares to the market. And funny enough, the lockup expiration date is sometimes in itself a bigger media day event for some companies than the actual IPO. A lot can happen in 180 days. An example of a successful direct listing is the Swedish company Spotify Technology, which was added to the New York Stock Exchange in April of 2018. Because Spotify was such a well-known company before the direct listing, they were able to take this taboo route to go public without having to pay large fees, build marketing and a hype, and rely on an underwriter's help. At the time we're making this video, Spotify's stock price has already doubled since its opening price of $165 per share in just its first 3 years on the market. If you want to see if companies like Spotify that have taken the direct listing route are still strong stocks to buy today, you can take a look at the 3 ratings from the Seeking Alpha authors, Wall Street sell-side analysts, and Seeking Alpha proprietary quant rating system as a Seeking Alpha premium user. Everyone gets a free 14-day trial of premium. Just use the link below this video to sign up. And if you want to learn more about the methods in which private companies go public, watch our other videos linked below on SPACs and IPOs.